Good morning, everyone. I'm going to wait just a couple of minutes to let everybody cycle in, and then we will get started. Okay, hello, everyone, and welcome to year-end M&A Outlook and Activity for 2023. We're glad to have you with us today. Before I introduce our speakers and get started, I have a few quick housekeeping items to go over. First of all, this webinar is being recorded, so be on the lookout later today for an email to you that has a link to the recording and also the slides. This webinar will run 50 minutes with 10 minutes Q&A immediately following. So if you have any questions for our speakers, please put them in the Q&A box located in the Zoom toolbar. To find your Zoom toolbar, just hover your mouse over the top or bottom of your screen and the toolbar will pop right up. All right, now I'd like to introduce our speakers. Pamela Bustos, CPA, is a tax partner at LSL CPAs and is entering her 30th year in public accounting. Her clients, which include privately held businesses ranging from manufacturers and distributors, professional service providers, and high net worth individuals, rely on her advice and assistance on a broad range of financial issues beyond tax compliance. She routinely provides solutions including business and multi-generational tax forecasting and planning, merger and acquisition guidance, and retirement planning. Robert Fahrenhorst is a director and manager at Plethora Businesses and advises clients in the acquisition and sale of lower middle market companies. At Plethora, he is directly responsible for the completion of more than 70 transactions, including traditional sales, recapitalizations, and mergers. His involvement in these mandates includes deal origination, negotiation, due diligence, and coordination of credit facilities. Robert's industry knowledge spans many sectors with specific focus in light manufacturing, value-added service, distribution, logistics, and food companies. Brandon Lanza is a financial analyst at Plethora Businesses and serves clients through sell-side engagements by aligning exit strategies with a network of potential investors. He is responsible for analyzing financial statements, completing business appraisals, generating valuation models, and evaluating company trends in relation to revenues, expenses, and strategic positioning. He conducts in-depth industry research to provide support in the valuation presentations, negotiations, and to expand on his knowledge of individual financial sectors. And now I'd like to hand it over to our speakers, so take it away, Brandon.
Thank you, Jill. I appreciate it. Good morning, everyone. Thank you for joining us. So let's begin with a 2022 year in review. So 2022 was definitely a mixed year. As we all know, it came hot off the heels of some of the record highs that we saw in 2021. And as shown in this chart to the right, where we saw an unprecedented number of total transactions and deal value, with the red line representing the number of deals and the blue line representing the value of the transactions. And of note, this is just showing deal volume in the US, which did account for nearly 50% of total global volume. So we were in the hottest of markets, so to speak. So with these new highs that we saw in 2021, there was a lot of optimism surrounding M&A activity. As we approached 2022, people were hoping that we could keep that pace going. As we saw, it's kind of hard to maintain that breakneck pace that we saw in 21. Instead, we're seeing more of a return to historical pre-pandemic averages, as shown in this graph here for the data point on 2022. Additionally, 22 faced some pretty significant headwinds. Inflation played a very large role. In June, we saw the highest annual increase in 40 years to the tune of about 9.1%. It has since cooled a bit, but we're still hovering around that 7.7 annual increase, which is pretty significant, especially considering the rate hikes we saw this year. So while everyone's aware of the downward pressure on M&A activity from inflation, we're also very aware of the interest rate hikes that we experienced. So we've seen 6 so far in 2022, with it beginning somewhat modestly in Q1 and just subsequently coming higher and higher through Q4, with a total of 375 basis points increase. When we compare that to 2020, where we experienced a 150 basis point decrease and the deal activity that followed, as seen in the chart, you can see how these headwinds, along with the general sentiment of an extended recession on the horizon, has led to an increase in the gap between forecasted and actual deal volume and value. And on this next slide here, when we look at this chart, we can see quarterly M&A activity represented throughout the past few years, with the solid blue bars representing actual deal value and the thin blue line representing actual deal count. Now compare and contrast that to the yellow dots that you see on the right, as well as the shaded blue bars. This illustrates the estimated deal volume and deal value for that period. And what this graph really serves to show is that this level of uncertainty that was created by the headwinds in 22 has created a fairly significant gap between actual and forecast. Now, while we are seeing this dampening of M&A activity compared to 21, it's not all doom and gloom. 21, as mentioned, was a record year. Deals were transacting at values and a pace that we haven't experienced before. Simply put, it was a pace that would be very difficult to maintain. Now, if we look at this chart and compare it to 2019 figures prior to the pandemic, prior to those rate decreases experienced in 2020, we see a much smaller and more reasonable shift in market activity. Now, this decrease in M&A volume that we experienced throughout the year was seen pretty much across the board, regardless of deal size. It could be for deals less than 100 million up to those mega 10 billion plus deals. But of note, those deals that are falling in the less than 100 million mark are still relatively consistent. While they have dampened a bit, we're seeing that they're still maintaining, pretty much their relative amount. Now, an additional headwind face was SPACs, special purpose acquisition companies. Now, they've been a hot button item for some time now, and were anticipated to be a key player for M&A activity in 2022. As those headwinds came up, a lot of these SPACs, they began to withdraw, which further added to the dampening of the market. And a similar withdrawal was also seen amongst strategics and private equity groups who opted to take more of a wait and see approach in 2022. And the benefits here were pretty much twofold. This allowed them to focus on integrating that portfolio that they acquired in 2021. And it also allowed them to gauge the market and capital environments to plan for 2023. And for some players, the end of Q4 of 2022, which is where we currently find ourselves. At time of these charts and this research, there was a slight estimate that 2022 Q4 might see a slight uptick, but we're still waiting on the data points for that. So even though no one has that crystal ball, it's still up in the air whether we will see a rebound and really by how much. And so we're starting to see some trends and some themes emerging here, both as a result of what we saw in 2022, coming off of 2021, and as a result of just modern technological advancement that never ceases. So with these trends, we can expect a cautious approach as we roll into 2023. On that front, the level of confidence or caution amongst executives can play a big role in dictating that tempo of Q1 in 2023. But as mentioned, even with the high degree of executive confidence, we're still seeing that gap between actual and forecast, and it's something that has to be accounted for. But what we can say with a degree of confidence is M&A activity will likely revert to pre-pandemic levels in 2022. That white-hot pace in 2021 is simply unsustainable in today's capital and lending environment. As an extension of that capital environment, we can expect there to be an increased value gap in what buyers are offering, what sellers expect, and the level of structure incorporated into each offer. Additionally, it'll likely result in interest in smaller deal size, distressed deals, and divestitures. Now, while 2022 M&A activity did see that slight decrease, progress marches on. New technologies, particularly disruptive technologies, are always on the horizon and can play a major role in just upending financial profiles amongst different sectors and their M&A activities. So when you couple that with big data, as it just keeps getting bigger, so does the analysis of that data. As systems become more robust, companies can gather and track increasingly more information, all of which will be of interest to a potential investor. So we can expect to see a gradual but nearly perpetual increase in the level of detail requested by buyers to inform their offer. So these nuances, mentioned here, these trends and themes, they're going to affect both strategic and private equity investors, but we will see some slight differences between the two. Now, so this chart to the right here is interesting and shows a few interesting trends. This illustrates the difference in transactions between strategic or corporate M&A buyers and private equity, or as mentioned in the graph, sponsor-backed buyers. Now, the blue line is indicating the number of strategic transactions, while the gray is representing private equity's transaction. And the thin yellow line you see above indicates the percentage of private equity buyers. Now, in looking at this, we see an interesting trend with private equity gradually increasing nearly every year, but we're seeing a minor contraction in 2022 down to about 36.5%. This goes hand in hand with the conclusion that we're arriving to, that the relative increase is anticipated in corporate M&A. That's where we're going to see a major focus, but by no means is private equity out of the game. Private equity can still be expected to make up a significant amount of deal volume in 2022, though with a small shift in focus. Like, we can expect the younger PE firms to be still flexible as to their size criteria, but we can expect some of the more established firms to instead focus on add-on acquisitions that would place them a little bit more similar to a strategic, but still very much in that financial buyer world. We can also anticipate a little bit more of a focus on smaller deal sizes, given the lending environment. The smaller the deal size, the more confident they are they'll be able to actually finance the transaction. But even with these headwinds aside, private equity is sitting on a mountain of dry powder, which they will intend to deploy. And as we see in this next slide here, private equity is an all-time high of about 3.6 trillion, with the majority of funds allocated towards buyouts. So while we do face that level of uncertainty and challenges for deal financing, this dry powder will not go unutilized. We can expect to see some significant activity on behalf of private equity in 2022.
Yeah, that's a good slide, Brandon. If we could just go back to that for a minute. As you're mentioning in the previous slide too, that private equity's 36% of the total deal volume. And what that basically is telling me is that they're the winning bid nearly 40% of the time. And these groups are very aggressive and in competing with strategic buyers. So as a seller, when you're thinking about who might be your most logical buyer, private equity could actually not only be one that would offer maybe a different structure or a different opportunity aside from the traditional merger of a corporation, two corporations, but they can actually be pretty aggressive and competitive in on the pricing side of a transaction. Now on this side, as it's pretty clear on the private equity dry powder, this is really saying how much does the firm, how much does the industry on private equity have to invest? And certainly we're at these records, but as you're thinking of selling and maybe you're contacted by a buyer, let's just say a private equity firm reaches out to you and says, hey, we'd really like to, pursue an opportunity here. As you go down that path, one of the things that you may want to think about is asking them for their sources and uses. And sometimes they'll provide that in their offer, and other times they won't. And that's a really great opportunity for you to say, hey, I'd like to know how you're going to be structuring this transaction. I don't know if my company is really set up for all this debt, or I don't know if I want my company laden with all this debt. We've gone all these years and have, we're basically debt free. I don't know if we're ready for that change. So that's a great point to inquire with the buyer. They're generally willing to share that information with you without hesitation, and it can help you make a decision if they're the right fit. So we wanted to also talk a little bit about, who are the heavy hitters in terms of industries, what industries are in trend right now. And, I think the last 5 to 8 years, technology has been, at the top, consistent. Energy, oil and gas has been trending the last year, as well as healthcare. Although we're seeing a softening on the general staffing side of healthcare, but pharma and biotech tend to be performing really well right now. Financial services are also leading the pack, and infrastructure has seen a nice uptick in the last year or so. What we also notice is that the B2B space, which is probably a lot of the folks that are listening to this call today, that sector is continuing to do well. That's represented by the dark blue bar at the bottom there, business products and services. And in 21 and 22, they continue to trend up. So thinking about trends and value drivers, what are attractive company characteristics? We've noticed, for instance, on the supply chain side, that product-based companies have really been stressed, due to the supply chain challenges, getting just product in on a timely basis so you can make your product and get it shipped out. And that's resulted in, for a lot of companies, just lower revenue. They just haven't been able to ship products. And we are working with buyers that are really inquisitive about that. They want to know, if companies have struggled getting product the last few years, what adjustments have they made to adapt to this environment? And you'll, I think, really stand out and help move through the process better if you said, hey, we ran into these issues, and these are the adjustments that we've made. We've local source, so we don't have maybe that time delay getting products shipped across the ocean and then getting it through the ports. We found local vendors, and/or we found multiple vendors that we can rely on. So maybe our top 3 key products, we've got multiple sources that we feel comfortable with. So if one falls off, there's a backup right there. And as Brandon mentioned earlier about technology and disruption, I think companies that are taking advantage of new technology to improve their operations really tend to stand out. Buyers like to see that, hey, we are embarking on this new software, or it could be an off-the-shelf, or it could be something that you're developing internally that we believe is going to streamline our this part of our business and increase margin. And it doesn't always have to reflect immediately on the bottom line, but the fact that you recognize there's opportunity, you're trying to take advantage of that, I think it will help you through the sale process as identifying maybe some low-hanging fruit for the buyer to take advantage of. They love to step into businesses that have this momentum for growth and momentum for profitability. And if you can kind of set the stage on some of those points, I think it would really help in the process. We also know that certain industries are going to be struggling. If we were to maybe look at the logistics space, right now we're noticing that rates are starting to come down, so that you might be able to argue that the industry is starting to fall a little bit out of favor. But within any industry, there are going to be companies that are performing very well. So if you have, for instance, margins above your industry peers, then you have something unique about your company, and that will attract buyers. It does help to benchmark your company against other firms, and your M&A broker can help you with getting that data and kind of analyzing, how do you fit amongst your industry peers, and where are your strong suits, and you'd want to highlight that in the sale process. Companies that have a strong management team are always going to do better. It's not always the best option for a smaller company, but as you start to mature and you have the ability to build out that infrastructure, the more you can say, I have a team behind me that pretty much runs the company, makes it easier for a buyer to envision, how am I going to transition this company after the owner decides to retire. And thinking about this slide, years ago I talked to a private equity buyer, and they were in our office, and we were talking about a company that they wanted to pursue. And he said to me, he said, I need to know any company that I buy is a leader. And I said, okay. I said, that's great, but not every company is a leader. And they said, it doesn't matter. You just need to find how the company's a leader. It could be in your local market. You could be a leader in the city or the region within your state. You might be one of the top 3. But what that kind of impressed upon me many years ago was looking for different ways to present your company to a buyer. And as you're considering a sale, kind of be looking at those nuances that maybe you never really thought of, like what makes you unique, what makes you potentially a leader in what you do. And you don't have to be a national leader, but maybe in more of a local basis, you might be able to identify some unique opportunities for a buyer. So moving to Interest rates. So we wanted to share briefly a chart that highlights the interest rates compared to deal activity. So the gold bars there are just simply the interest rate during that year. And the year starts at 2000 and takes us to 2021. And it overlays the number of transactions and the value of transactions. And you can sort of see a little bit of a correlation. I mean, there's other factors, of course, that drive the market, but you can see when interest rates are high, there's a bit of a lagging effect for deal activity. And if we were to play this chart out to this year, we know rates are back up quite a bit. There's been substantial increases this year, and we're starting to see deal volume fall off. So I think the question is, will we have these sustained rates by the Fed? Will we see more rates next year? I think there's a lot of chatter about, yeah, we're going to see some more increases, and I think that will potentially put some, prolonged pressure on deal volume and deal value. As we're thinking about private equity, being a formidable player in the market, we want to recognize that, they leverage their acquisitions, and it's not uncommon to see a private equity group take 70-80% debt on a deal. And I think many are going to struggle to be competitive in this market because of that. They just can't make the dynamics work with such high rates and the leverage that they take. But as you're talking to buyers, you may want to ask a PE firm, how have your other portfolio companies performed? And maybe inquire a little bit about the owners that they've sold to them in the past, and maybe ask to speak with them. I think you can get an insight how maybe a group has, maybe say they got 5 or 10 companies, how they performed in up and down markets, and might give you a little insight as to, if this group is going to leverage. They seem like a great fit. I'm not so excited about the level of debt that they're going to be putting on this business, but maybe they've proven to be successful with that model in prior acquisitions. And don't be hesitant to do a little due diligence of your own on these companies that they own. So we wanted to cover maybe a few trends for what to expect in the next year, topics that you might encounter in a sale process. And I think a lot of companies have really done well the last year, and buyers are going to say, well, how did you grow your company? If it was just price increases, we were all talking about inflation. If you've only had growth through price increases, I think that's not going to be as exciting as, we've been able to grow by expanding with current clients, grabbing some market share, maybe new clients. So it's kind of a little bit of a double-edged sword that you want to be prepared to address that question. And as a buyer, they're going to know, are these prices increases, are they sustainable? Can you continue to take up your pricing, whatever it's been the last few years, or is it going to maybe level off? So it might be something to look at. Inventory is going to be front of mind for any product-based company. We mentioned earlier about the supply chain issues, and I'm surprised at how many companies that we work with, business owners that don't have physical counts, so don't have a perpetual inventory system to accurately depict what their inventory is on a month-to-month basis. And if those are systems that you've maybe thought about putting into place and maybe you haven't yet, it might be a good time to start setting those benchmarks for where your inventory is at. That can, of course, impact your profitability. And as a buyer, they're making their offer based on your profitability. So if they can't get to understanding what the real number is, because there's maybe that lack of control over inventory, it's going to make it more challenging to get through a sale process. And what you'll likely encounter are buyers that will still show interest, but they're going to want to structure the deal more heavily, where there's a post-closing payment based on actual performance of the company. So a buyer coming in would do a physical closing, and now that would be the starting point. And then a year or two later, then you would evaluate the actual performance of the company, and then there would be that second payments. But I know a lot of owners don't want to hand the keys to someone else and give up control and not know if they're going to be guaranteed those payments. So you may want to look at that. Accounts receivable, it's always good to kind of look at the agings, and it might identify maybe some cracks in the system, maybe customers that all of a sudden they're starting to slow pay. And you may want to inquire, is there maybe a deeper problem with that customer that if they're a major one for you as a percentage of sales, you may want to look at how to protect yourself from, from something a little more serious from a non-payment perspective. Cybersecurity is definitely a trending topic. I'm sure at some point or another we've heard of, ransomware, a school or college or some large business got hacked and their data was compromised and they couldn't access it. And it happens more than you think. And the real reason is no one wants to admit that they got hacked. So if they can avoid letting that data, that information out there that they were compromised, they're going to try to do that. But it happens quite a bit. And a lot of these companies thought they were safe. They thought that I have a cloud and I'm safe, I'm in the cloud, but the hackers don't care where your data is at. If it's not properly protected, they can compromise it at the cloud and then on any devices you have on-prem. They know what to look for. So it may be worthwhile to talk to your managed service provider and inquire about what do I have as security? What the worst case scenario? How do I know my data? I can access it. And investors, they want to know that those things are in place, or they prefer to have them in place. The last thing they want is to acquire a company, and then 2 months later, there's some issue that they didn't think about, and now they're they've got to answer their investors why the business can't continue until they pay the ransom. With regards to third-party claims, it's always good to kind of look at things like, for instance, on the employee side, are you adhering to all of the labor law? And your attorney could be a great source to just do a quick check and make sure that if maybe you're in a gray area in certain aspects of how you maybe do your time cards, for instance. We've had issues where there's just been a kind of a casual approach to letting employees clock in and clock out, even though they're not working, they're there, and the data doesn't match up to how much they're paid and when they're actually checking into the system. It may be good to have a look through that. So as you get deeper in the process and buyers are starting to kind of look into these areas of your company, you've thought through it and you're not trying to scramble and say, wait a minute, we do it right, but I know it doesn't look great here, but it's really, we're not underpaying our employees. It may be better to address that before you move through the process. And then ESG is definitely a trending topic. It has to do with non-financial metrics in determining a company's performance. So why is that important to you as an owner? You're running your business. Why do I care about ESG? Well, buyers will most likely care about ESG, especially the large corporations, even private equity. Their funds are often rated on how highly they score on ESG. And so that rating is based on their portfolio companies and how much they adhere to, social, environmental issues. So if they're looking at adding another company and they're looking at two potential candidates, and one is ESG and one is not, then you know which one they're going to probably pursue, all other things being equal. So there are opportunities for you to look at like an assessment, to do an analysis, and ISO actually has a protocol for ESG. So it doesn't cost anything. You can go to ISO, you can look up I believe it's ISO 2600, and look at their list. And that's a great starting point to see if there's anything that you're currently doing or that maybe you could quickly pursue without a big expense, and kind of get that ball rolling. And I think it'll pay dividends as you are thinking of a potential sale. representation and warranty insurance. If we can move to the next slide. I wanted to take the opportunity to talk about why representation and warranty insurance could be important to you. So when you're selling a company, even if you get an offer for all cash, let's say it's a $10 million transaction, they're going to pay you $10 million. Well, it's unlikely that they're going to pay you that 100% close. They're going to say, you know, we've done due diligence, but we're not certain that we know of all the potential liabilities that could come up after closing that actually were related to when you own the business. So we would like to hold some money back in escrow for a period of time. That's usually 12 to 24 months. And if there's no claims, there's nothing that comes up, we don't have any unusual findings that, you know, are detrimental to the business, then we'll release that money to you. Now, as an owner, especially if you're thinking of retirement and trying to really look down to the dollars and cents of what you'll need to retire, they may want to hold back out of a 10 million, maybe 750,000 in escrow. And that is a substantial number, and you may be uncomfortable with that. So what can you do to minimize that amount of holdback? And traditionally, what companies have done is they've had tail insurance on things like D&O insurance, employment liability, but it won't cover everything. It won't cover all aspects of your business. So representation and warranty insurance is a way for a third party to step in during the sale process and provide you with a policy, or provide the buyer with a policy that will help indemnify you, protect you, and make a buyer whole if there is a claim. So that could be a way to get actually 100% cash at closing and incur some nominal expenses. So what would be, for instance, the typical cost on a transaction? Well, the first thing to keep in mind is that a representation and warranty policy is not going to ever cover 100%. It's going to cover a percentage of the deal, typically about 10%. So about $1 million of coverage. And the premium is going to be somewhere between 2 and 4%. So you have that upfront cost, and you typically have an underwriting fee. It can vary from 30 to 40,000. It's pretty static, but you have to know that just exploring this and having a party insurance company look at the deal, they're going to want to check for 30 to 40K. And then there's typically a deductible of 1 to 3%. So, you know, there's some other considerations, but it could be a way to not only maximize what you're able to receive at closing, but it can also help in the negotiation process. So if you have a buyer that is more risk adverse, they expect a transaction where they might say, hey, you know, we want more indemnity, we want a higher percentage of clawback if there is a claim, and they're asking for all these things. And you guys say, yeah, I like you as a buyer, but I can't, you know, I can't do this. I need to know that I have a certain amount that I can count on, and you're not going to come back and try to be made whole on that. So this is a way where if you have that policy, you might say, yeah, I'm a little more comfortable with some of the asks of the buyer because I know I have this protection. Now, up to this point, representation warranty insurance has been for typically larger transactions, 50 million, 100 million and up. And there are now companies that are stepping into the market saying, hey, we see an opportunity here. And there's tens of thousands of, you know, Main Street and lower middle market deals that are underserved. And now we're seeing companies that are willing to touch deals under $1 million, 5 million, 10 million. And probably a lot of folks that are on the phone might fall in that category. So it's not just something to talk about as a topic, it's actually something that can help you because there actually are products that could apply to your transaction. Now, one last point I wanted to make on this is R&W insurance can also be purchased by the buyer. So when you receive an offer and that offer is detailed about certain things, you might take the opportunity to say, hey, you know, we want you to get an R&W policy in place. And that will help increase your leverage from what they're going to ask for downside protection. And it wouldn't be unreasonable for you to say, buyer, I want you to pay for it. Or I'm willing to split the cost of the premium with you. I mean, there's a lot of give and take in every deal, but it's a great time at the point of offer to say, let's talk about this. Let's all agree that this is something that will be in place prior to closing. If you wait in due diligence, the focus of the buyer is now on other things, and they may be less inclined to take on a policy and go through that cost and time. So the timing of you introducing it is very important. And I think with that, I'd like to hand it over to Pam Bustos for an insight on tax topics.
Thanks, Robert. I appreciate that. So as we all know, taxes get all of us, and in every transaction, effective tax planning is super important. So you typically need to plan for how a sale will be taxed. Typically, sellers want to sell stock or partnership interests, which are generally taxed as capital gain with some exceptions. However, buyers can't depreciate stock. If you think of any stock purchase you might make in your brokerage account, you know that this isn't something that depreciates, though of course it changes in value up and down over time. But instead, buyers would prefer asset purchases in which some assets can be depreciated or amortized. Sellers on these transactions are then taxed at both ordinary and capital gain income tax rates, depending on the makeup of the assets sold. And on my next slide, you should often consider restructuring options. And this can be a typical part of sale transaction planning, can be crucial to closing a deal that satisfies both a seller and a buyer. So you have to look at how the business is currently structured. What type of entity is selling? Is it a corporation? Is it a C corporation, an S corporation, or perhaps a partnership, which may include your LLC structure? If a restructuring is needed, or perhaps a tax gross up in sales price might be needed to cover the increased tax cost to the seller, structured in a way that helps the buyer with future depreciation and amortization, and ultimately helps close the deal. For example, in an asset sale, the sales price is allocated to specific assets, which affects their depreciable life and can have huge tax implications. If so, there are many options available to structure a deal that can make both the seller and buyer happy. For example, in a partnership or LLC, if it's sale of assets or partnership interest, a sale of a partnership interest is a capital asset transaction. If it's an asset sale for the buyer, though, it results in a higher tax cost to the seller with a gross up in sales price, which compensates the seller for this additional tax cost. This could make the deal more appealing to the buyer because in an asset purchase, the buyer then can depreciate and amortize those assets purchased. But if they bought a partnership interest, you can't depreciate the partnership interest. So it helps the return on investment to the buyer by having depreciable and amortizable assets that they've purchased versus a partnership interest. Similarly, with C corporations or S corporations, the buyer typically wants to buy assets while the seller would prefer to sell stock. But stock sales can be structured as asset sales. The notable elections available to accomplish this include Internal Revenue Code 338H10 and 336E. I know those are technical codes, but they're very important, as well as the 368A1F. 368A1F is typically known as an F reorganization, and it typically allows you to treat it as if it's an asset sale, even though it is technically a partnership interest sale. Of the other two, the 338H10 is more common. And if the election is made, only corporate level gain on the deemed asset sale is recognized, and the shareholders of the corporation do not recognize any gain on the actual stock sale. And if the selling corporation is a member of a consolidated group of corporations, losses from other entities can shelter the gain from the selling company. This 338H10 election could trigger built-in gains for an S corporation that was formerly a C corporation if the sale involves appreciated assets during the recognition period. This was important on a sale that our company helped a client with earlier this year. And currently this period is 10 years for federal and 5 years for California, meaning if you've made your C corporation an S election in the past 10 or at least 10 years prior, this won't affect you for federal, but if it's within the 5-year window for California, it could. Both types of these transactions are stock sales and purchases for legal purposes. However, for tax, they are treated as asset sales and purchases. And with S corporations, another concern is prior to closing the deal, the S corporation must maintain its status as an S corporation. If the company that's being acquired, which is called the target, inadvertently invalidates its S election at some point before the deal closes, it could end up having the buyer own stock instead of assets. And another concern is that there's no tax deferral for partial rollover transactions. This is where the seller maintains partial ownership to keep some what we call skin in the game, to ensure a smooth transition. Frequently, clients will sell only a portion of their companies and stay on for some period of transition time. And so it's very different from what you might have all heard of in the real estate world, the 1031 exchange, where you can sell your real estate, exchange to new real estate, and it's a full rollover. This is not the case in company mergers and acquisitions. There's no rollover. And then the final, what I mentioned, the F reorganization, it can give the purchaser a step up in the tax basis of the assets being purchased, and the same treatment to sellers under 338H10, but without needing to acquire at least 80% of the target corporation. The buyer can also retain the federal ID number of the acquired company, even though it's an asset purchase, and that's important to avoid having to revise numerous contracts and that they might have in place, which can be tedious, and as well as payroll reporting and so forth. So let's talk about the purchase price allocation. It should be agreed upon early in a deal structuring, and it's key to determine the tax effects of how a deal is structured. It is so integral to the overall outcome of a deal to both the buyer and seller that the seller would prefer to allocate sales price to capital gain assets such as goodwill, whereas the buyer wants a good allocation for assets towards things like equipment or real estate that can be depreciated in the future. It's important to agree in concept early in the deal, as it could cause a deal to fail at the last minute if the parties don't agree. Both the buyer and seller should file an identical Form 8594, which is called the Asset Acquisition Statement, with their tax returns. And this puts the IRS on notice that the buyer and seller are treating the transaction the same. That the seller is reporting a sale of goodwill, and the buyer is then amortizing that same identical dollar amount for goodwill. When we talk about purchase price allocation in the early part of a deal, oftentimes, and depending on the industry, the buyer can have more leverage in this. For one of my recent clients earlier in 2022, one of our clients sold their business to a larger player in their industry, and the purchase price